Question 1. Implementation of a new investment product by a financial advisor involves a third-party provider offering a significant commission to the advisor for each client who invests in the product. The advisor has identified the product as potentially suitable for several clients, but the commission structure is not publicly disclosed to clients. The advisor must decide how to proceed with recommending this product. Option A. Decline to recommend the product due to the potential conflict of interest created by the commission, even if it is suitable for clients. Option B. Recommend the product to all clients, regardless of suitability, to maximize the commission earned. Option C. Recommend the product to suitable clients without disclosing the commission structure, focusing on the product's potential benefits. Option D. Recommend the product to suitable clients only after conducting a thorough suitability assessment and disclosing the commission structure to them. The correct answer is D. Recommend the product to suitable clients only after conducting a thorough suitability assessment and disclosing the commission structure to them. Explanation. This scenario presents a professional challenge because it requires balancing client interests with regulatory obligations and internal company policies. Advisor must navigate potential conflicts of interest and ensure that their recommendations are not influenced by personal gain or undue pressure from a third party. The core of the challenge lies in making a decision that is demonstrably in the client's best interest, even when presented with an attractive incentive. The correct approach represents best professional practice because it prioritizes the client's financial well-being and adheres to the principles of fiduciary duty, which are fundamental in financial advisory roles. This approach involves a thorough, objective assessment of the investment suitability for the client, considering their risk tolerance, financial goals, and existing portfolio. It also involves transparent disclosure of any potential conflicts of interest, as mandated by regulations governing financial advice. This ensures that the client can make an informed decision, free from the influence of undisclosed incentives. An incorrect approach that focuses solely on the incentive offered by the third party would represent a significant regulatory and ethical failure. This would likely breach the duty to act in the client's best interest and could violate rules against receiving undisclosed inducements or kickbacks. Such an approach prioritizes personal or firm benefit over client welfare, undermining trust and the integrity of the financial advisory profession. Another incorrect approach that involves making a recommendation without a comprehensive understanding of the client's circumstances, even if the investment is generally sound, would also be a failure. This neglects the personalized nature of financial advice and the regulatory requirement for suitability assessments. Professionals should employ a structured decision-making framework that begins with identifying the client's needs and objectives. This is followed by researching and evaluating suitable investment options, considering all associated risks and benefits. Crucially, any potential conflicts of interest or inducements must be identified, assessed, and disclosed transparently to the client. The final decision should always be justifiable as being in the client's best interest, supported by objective analysis and adherence to all relevant regulatory and ethical standards. Question 2. The efficiency study reveals that certain back-office processes can be significantly streamlined by automating data entry and reducing manual oversight. This automation is projected to yield substantial cost savings. However, the proposed automation might bypass some existing checks designed to identify suspicious transaction patterns, which are crucial for anti-money laundering (AML) compliance. What is the most appropriate course of action for the firm? Option A. Conduct a thorough review of the proposed automation's impact on AML controls and regulatory reporting obligations, and only proceed with modifications that maintain or enhance compliance, potentially adjusting the automation scope or investing in enhanced automated AML monitoring tools. Option B. Proceed with the automation and rely on the compliance team to conduct post-implementation spot checks to identify any AML issues that may arise. Option C. Defer the automation of these specific processes until a comprehensive review of the entire AML regulatory framework can be completed, even if this delays the efficiency gains. Option D. Implement the automation as planned to achieve the projected cost savings, assuming that the existing AML framework is robust enough to absorb any minor reduction in oversight. The correct answer is A. Conduct a thorough review of the proposed automation's impact on AML controls and regulatory reporting obligations, and only proceed with modifications that maintain or enhance compliance, potentially adjusting the automation scope or investing in enhanced automated AML monitoring tools. Explanation: this scenario presents a professional challenge due to the inherent conflict between achieving operational efficiency targets and upholding regulatory compliance and ethical conduct. The pressure to reduce costs and streamline processes, as highlighted by the efficiency study, can tempt individuals to overlook or minimize regulatory requirements if they are perceived as hindrances. Careful judgment is required to balance these competing demands, ensuring that efficiency gains do not come at the expense of client protection or market integrity. The correct approach represents best professional practice because it prioritizes adherence to the Financial Conduct Authority (FCA) handbook, specifically focusing on principles such as acting with integrity, due skill, care, and diligence, and treating customers fairly. It recognizes that regulatory breaches can lead to significant fines, reputational damage, and loss of client trust. By proactively identifying and addressing potential compliance gaps identified by the efficiency study, the firm demonstrates a commitment to responsible business conduct and robust risk management, which are fundamental to maintaining its license to operate and its standing in the market. This approach aligns with the FCA's objective of ensuring that firms conduct their business in a way that protects consumers and promotes competition. An incorrect approach that prioritizes cost reduction over regulatory review would be professionally unacceptable. This would likely involve a failure to comply with the FCA's principles for businesses, particularly Principle 3, Financial Prudence, and Principle 6, Customers' Interests. Specifically, it could lead to breaches of rules related to client asset protection, anti-money laundering AML procedures, or data security, depending on the nature of the efficiency measures. Such a failure would expose the firm to regulatory sanctions, including fines and potential disciplinary action, and would erode client confidence. Another incorrect approach that involves implementing efficiency measures without a thorough understanding of their impact on regulatory obligations is also professionally unsound. This demonstrates a lack of due diligence and a failure to act with due skill, care, and diligence. It could result in unintended breaches of regulations, such as those governing product suitability or complaint handling, because the new processes might inadvertently create loopholes or bypass necessary checks. This approach risks creating systemic compliance issues that are harder to rectify later. A third incorrect approach that involves selectively implementing efficiency measures based on perceived ease of implementation rather than their overall impact on regulatory compliance and client outcomes is also unacceptable. This demonstrates a lack of a holistic and principled approach to business change. It suggests a prioritization of superficial gains over substantive adherence to regulatory standards and ethical obligations, potentially leaving the firm vulnerable to regulatory scrutiny and client detriment. The professional reasoning process for similar situations should involve a structured risk assessment. First, identify the proposed efficiency measures and their intended outcomes. Second, critically evaluate each measure against relevant regulatory requirements and ethical principles. This involves consulting the FCA handbook and seeking expert advice if necessary. Third, assess the potential risks and benefits, considering both financial implications and the likelihood and impact of regulatory or ethical breaches. Fourth, develop mitigation strategies for identified risks. Finally, implement the chosen approach with ongoing monitoring and review to ensure continued compliance and ethical conduct. Question 3. The assessment process reveals that a client, who is a close friend of a senior executive at a publicly listed company, has inquired about the potential impact of an upcoming, unannounced merger on the company's stock price, hinting at having prior knowledge. Option A. Immediately report the conversation and the client's inquiry to the firm's compliance department for investigation and guidance. Option B. Advise the client on potential investment strategies based on the perceived market sentiment, without directly confirming or denying any specific information. Option C. Discreetly research publicly available information to gauge general market trends that might be relevant to the company's sector. Option D. Inform the client that such inquiries are sensitive and suggest they consult with their personal financial advisor for investment decisions. The correct answer is A. Immediately report the conversation and the client's inquiry to the firm's compliance department for investigation and guidance. Explanation: The assessment process reveals a common challenge in financial services, balancing client needs with regulatory obligations. Specifically, this scenario tests an individual's understanding of the UK's regulatory framework concerning client best interests and the prevention of market abuse, as governed by the Financial Conduct Authority, FCA. The professional challenge lies in identifying and acting upon potential insider information without breaching confidentiality or engaging in prohibited activities. Careful judgment is required to navigate the gray areas between legitimate client service and regulatory noncompliance. The correct approach represents best professional practice because it prioritizes adherence to regulatory requirements and ethical conduct. By immediately escalating the situation to the compliance department, the individual demonstrates a commitment to the FCA's principles for businesses, particularly Principle 1, integrity, and Principle 2, skill, care, and diligence, and the Market Abuse Regulation, MAR. This action ensures that the firm can investigate the matter appropriately, protect client interests, and prevent any potential market abuse, thereby upholding the integrity of the financial markets. An incorrect approach that involves acting on the information for the client's benefit, even with good intentions, represents a significant regulatory and ethical failure. This would likely constitute insider dealing or encouraging insider dealing under MAR, which carries severe penalties. It breaches the duty to act in the client's best interests by exposing them to illegal activity and jeopardizes the firm's reputation and regulatory standing. Another incorrect approach, such as ignoring the information due to uncertainty or a desire to avoid conflict, is also professionally unacceptable. This failure to act demonstrates a lack of diligence and a disregard for potential regulatory breaches and client harm. It could be construed as a failure to identify and report suspicious activity, which is a core responsibility under the regulatory framework. The professional reasoning process for similar situations should involve a clear understanding of the firm's internal policies and procedures, alongside relevant regulatory guidelines. When faced with potentially sensitive or non-public information, the immediate step should be to consult compliance. This ensures that any action taken is informed, compliant, and in the best interests of both the client and the integrity of the financial markets. The decision-making framework prioritizes transparency, adherence to rules, and seeking expert guidance when in doubt. Question 4. The assessment process reveals that a client, who has been with the firm for several years and has a moderate risk tolerance, is requesting to invest a significant portion of their portfolio in a highly speculative, unlisted technology startup. The firm's internal policy, developed in line with FCA guidelines on product governance and suitability, restricts investments in such ventures for clients with a moderate risk profile due to the inherent volatility and lack of regulatory oversight. The advisor recognizes the client's enthusiasm, but is concerned about the potential for substantial losses and the policy's implications. Option A. Explain to the client that while the firm values their business, the proposed investment falls outside the firm's approved product list for clients with their risk profile, citing the firm's commitment to regulatory compliance and client protection as the primary reason. Offer to explore alternative suitable investment opportunities that align with their risk tolerance and financial goals. Option B. Inform the client that the investment cannot be made due to internal policy, but do not provide a detailed explanation, suggesting they seek independent financial advice for such specific ventures. Option C. Immediately escalate the request to the compliance department without any initial discussion with the client to seek a definitive ruling on whether the investment can be made. Option D. Proceed with the investment as requested by the client, assuming the client understands the risks involved and is willing to accept them, as the client has a long-standing relationship with the firm and has expressed strong conviction. The correct answer is A. Explain to the client that while the firm values their business, the proposed investment falls outside the firm's approved product list for clients with their risk profile, citing the firm's commitment to regulatory compliance and client protection as the primary reason. Offer to explore alternative suitable investment opportunities that align with their risk tolerance and financial goals. Explanation. The assessment process reveals a common challenge in financial services, balancing client needs with regulatory compliance, particularly concerning the implementation of new internal policies. This scenario is professionally challenging because it requires an individual to navigate potential conflicts between a client's stated preferences and the firm's adherence to regulatory mandates. The firm's obligation to comply with regulations, such as those overseen by the Financial Conduct Authority, FCA in the UK, takes precedence over a client's desire to engage in activities that may be deemed too risky or outside the firm's approved product suite. Professional judgment is required to explain these limitations clearly and ethically to the client, ensuring they understand the rationale behind the firm's decisions. The correct approach represents best professional practice because it prioritizes regulatory compliance and client protection. By adhering to the firm's internal policy, which is designed to meet regulatory requirements, e.g., suitability rules under the FCA's Conduct of Business Sourcebook COBS, the advisor ensures that the client's investments are appropriate for their circumstances and risk tolerance. This aligns with the FCA's principles for business, particularly Principle 2, Skill, Care, and Diligence, and Principle 9, Customers' Interests. It demonstrates a commitment to acting honestly and with integrity, safeguarding the client from potential harm that could arise from unsuitable investments. An incorrect approach that involves overriding the internal policy to accommodate the client's request would represent a significant regulatory and ethical failure. This would violate the firm's internal controls, which are established to ensure compliance with external regulations. Specifically, it could breach COBS rules regarding the suitability of investments, potentially exposing the client to undue risk and the firm to regulatory sanctions. Furthermore, it would undermine the principle of treating customers fairly, as the advisor would be prioritizing a short-term client relationship over the client's long-term financial well-being and regulatory protection. Another incorrect approach, such as simply refusing the client without a clear explanation, would fail to uphold the duty of care and could lead to client dissatisfaction and potential complaints, demonstrating a lack of professional communication and client management skills. The professional decision-making process for similar situations should involve a clear understanding of the firm's internal policies and their regulatory underpinnings. When faced with a client request that conflicts with these policies, the professional should first consult the relevant regulatory guidelines and internal procedures. If the request appears to fall outside approved parameters, the professional should clearly and empathetically explain the reasons to the client, referencing the firm's commitment to their best interests and regulatory compliance. Escalation to a supervisor or compliance department should be considered if there is any ambiguity or if the client remains insistent. The ultimate goal is to find a solution that is both compliant and, where possible, meets the client's underlying needs within the established framework. Question 5. Assessment of the appropriate course of action when a client with limited investment experience insists on purchasing a complex derivative product that appears to exceed their stated risk tolerance and financial capacity, despite the advisor's initial concerns. Option A. Execute the transaction immediately as requested by the client, relying on a signed disclaimer to absolve the firm of responsibility. Option B. Conduct a detailed suitability assessment to determine if the derivative product aligns with the client's financial objectives, risk tolerance, and knowledge, and if not, explain the concerns and propose suitable alternatives. Option C. Suggest a different, less complex investment product without first fully understanding the client's underlying reasons for requesting the derivative. Option D. Inform the client that the product is too complex for them and refuse to execute the transaction without further discussion or alternative suggestions. The correct answer is B. Conduct a detailed suitability assessment to determine if the derivative product aligns with the client's financial objectives, risk tolerance, and knowledge, and if not, explain the concerns and propose suitable alternatives. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated desire for a specific investment product and the advisor's fiduciary duty to ensure suitability. The advisor must navigate the client's potential lack of full understanding of the product's risks and complexities, while also respecting their autonomy. The challenge lies in balancing the client's instructions with the regulatory obligation to act in their best interests, particularly when the requested product might not align with their financial objectives or risk tolerance. This requires careful judgment, clear communication, and a thorough understanding of both the client's circumstances and the product's characteristics. Correct approach analysis. The correct approach represents best professional practice because it prioritizes the client's best interests, a cornerstone of regulatory compliance and ethical conduct within the financial services industry. By conducting a comprehensive suitability assessment, the advisor fulfills their fiduciary duty. This involves gathering detailed information about the client's financial situation, investment objectives, risk tolerance, and knowledge of financial products. This process ensures that any recommendation or execution of a transaction is aligned with what is genuinely appropriate for the client, rather than simply what the client requests without full comprehension. This aligns with principles of client protection mandated by regulations such as the FCA's Conduct of Business Sourcebook, COBS, in the UK, which emphasizes the need for firms to act honestly, fairly, and professionally in accordance with the best interests of their clients. Incorrect approaches analysis. Proceeding with the client's request without a thorough suitability assessment represents a significant regulatory and ethical failure, breaches the duty to act in the client's best interests, potentially exposing the client to undue risk or unsuitable investments. This could contravene COBS 9A, which mandates that firms must take reasonable steps to ensure that financial instrument is suitable for a client. Blindly executing the order, even with a signed disclaimer, fails to address the underlying issue of suitability and could be seen as an attempt to circumvent regulatory obligations. Offering an alternative product without first understanding the client's specific needs and the rationale behind their initial request is also problematic. While offering alternatives can be part of a good advisory process, doing so without a proper suitability assessment first is premature and may not address the client's actual, albeit potentially misunderstood, needs. It risks pushing a different agenda rather than genuinely helping the client. Professional reasoning. Professionals should adopt a structured decision-making process that begins with understanding the client's needs and objectives. This involves active listening and probing questions to uncover their financial situation, risk appetite, and investment goals. Following this, a thorough assessment of the suitability of any proposed product or service is paramount, comparing it against the gathered client information. If a client requests a specific product, the advisor must verify its suitability. If it is not suitable, the advisor has a duty to explain why, in clear and understandable terms, and to propose suitable alternatives. Documentation of all client interactions, assessments, and recommendations is crucial for demonstrating compliance and professional diligence. This systematic approach ensures that client interests are protected and regulatory requirements are met. Question 6. Comparative studies suggest that financial institutions often struggle to accurately gauge the full implications of new regulatory directives. When faced with a significant upcoming regulatory change impacting client reporting requirements, which approach to assessing its impact would best align with robust risk management and regulatory compliance principles? Option A. Delegate the entire impact assessment process to an external consultancy firm, relying solely on their report for implementation decisions. Option B. Prioritize immediate cost reductions by streamlining reporting processes based on the assumption that efficiency gains will naturally mitigate any compliance risks. Option C. Adopt the reporting procedures implemented by a leading competitor, assuming their approach is already compliant and efficient for similar client segments. Option D. Conduct a comprehensive impact assessment that analyzes potential changes to operational processes, IT systems, staff training, client communication, and financial implications, involving cross-departmental input and stakeholder engagement. The correct answer is D. Conduct a comprehensive impact assessment that analyzes potential changes to operational processes, IT systems, staff training, client communication, and financial implications, involving cross-departmental input and stakeholder engagement. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent uncertainty in predicting the precise impact of regulatory changes on a financial institution's operations and client base. The firm must balance proactive adaptation with resource allocation, ensuring that any proposed changes are both effective and compliant without causing undue disruption. The need for a robust impact assessment stems from the potential for significant financial, operational, and reputational consequences if the changes are not adequately understood and addressed. Correct approach analysis. The correct approach involves a multifaceted impact assessment that considers both quantitative and qualitative factors. This includes analyzing potential changes to capital requirements, operational processes, IT systems, staff training needs, and client communication strategies. It also necessitates engaging with relevant stakeholders, including compliance, risk management, IT operations, and business lines, to gather diverse perspectives and ensure a comprehensive understanding of the potential effects. This approach aligns with regulatory expectations for prudent risk management and proactive compliance, ensuring that the firm can adapt to new requirements efficiently and effectively, thereby safeguarding its financial stability and client trust. It reflects a commitment to understanding the full scope of implications before implementing changes, a cornerstone of good governance and regulatory adherence. Incorrect approach is analysis, focusing solely on immediate cost savings without a thorough analysis of operational disruption or client experience, represents a significant regulatory and ethical failure. This narrow perspective risks overlooking potential compliance gaps, increased operational risks, and negative client sentiment, which could lead to regulatory sanctions and reputational damage. Implementing changes based on anecdotal evidence or the practices of a single competitor, without a bespoke impact assessment tailored to the firm's specific structure and client base, is also professionally unacceptable. This approach lacks the rigor required by regulatory frameworks that demand a deep understanding of how changes will affect the firm's unique circumstances. It can lead to unintended consequences and noncompliance due to a failure to account for the firm's specific risk profile and operational complexities. Relying exclusively on external consultants to define the impact without internal validation and engagement is another failure. While consultants can provide valuable expertise, the ultimate responsibility for understanding and managing regulatory impact lies with the firm's management and relevant departments. This approach can lead to a disconnect between external recommendations and internal realities, potentially resulting in ineffective or non-compliant implementation. Professional reasoning. Professionals should adopt a structured, risk-based approach to impact assessment. This involves 1. Identifying the specific regulatory change and its scope. 2. Defining the objectives of the impact assessment. 3. Mapping out all potentially affected areas within the organization, e.g., systems, processes, people, clients. 4. Gathering relevant data and information, both quantitative and qualitative. 5. Analyzing the potential impacts, considering both direct and indirect consequences. 6. Identifying mitigation strategies and control measures. 7. Documenting the assessment and its findings. 8. Communicating the findings to relevant stakeholders and decision makers. 9. Monitoring the implementation of mitigation strategies and the actual impact of the changes. This systematic process ensures that all relevant factors are considered, leading to informed decision-making and effective adaptation to regulatory changes. Question 7. To address the challenge of launching a new innovative financial product, what is the most appropriate approach for Santander to ensure compliance with regulatory expectations and protect customer interests? Option A. Prioritize the speed of market entry by expediting the product development cycle and minimizing the time spent on impact assessment. Option B. Conduct a comprehensive impact assessment that evaluates potential effects on customers, operations, and regulatory compliance, developing mitigation strategies for identified risks. Option C. Focus the impact assessment primarily on the potential revenue generation and market share gains of the new product. Option D. Limit the impact assessment to only the immediate operational implications and technical feasibility of the product. The correct answer is B. Conduct a comprehensive impact assessment that evaluates potential effects on customers, operations, and regulatory compliance, developing mitigation strategies for identified risks. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent uncertainty and potential for significant consequences associated with a new product launch. The challenge lies in balancing the need for innovation and market competitiveness with the regulatory obligation to ensure customer protection and market integrity. A rushed or incomplete impact assessment can lead to unforeseen risks, regulatory breaches, reputational damage, and financial penalties for Santander. The complexity arises from identifying all potential impacts across various business functions, customer segments, and regulatory domains, and then devising appropriate mitigation strategies. Correct approach analysis. The correct approach involves a comprehensive, multifaceted impact assessment that systematically identifies, analyzes, and evaluates the potential effects of the new product on customers, the firm's operations, and its compliance with relevant regulations. This aligns with the principles of responsible product development and good governance, which are implicitly or explicitly mandated by regulatory frameworks such as those governing financial services in the UK, e.g., FCA's Principles for Businesses, SISC Sourcebook. A thorough assessment ensures that risks are understood and managed proactively, customer interests are safeguarded, and regulatory obligations are met. This approach demonstrates a commitment to treating customers fairly and maintaining market confidence. Incorrect approach is analysis, focusing solely on the potential revenue generation of the new product, without a corresponding rigorous assessment of risks and customer impact, is a significant regulatory and ethical failure. This approach prioritizes commercial gain over customer well-being and regulatory compliance, potentially leading to breaches of conduct rules that require firms to act in the best interests of their clients and to manage risks effectively. Prioritizing the speed of market entry above all else, even if it means skipping or abbreviating key impact assessment steps, is also a failure. This haste can result in overlooking critical risks, inadequate controls, and a product that is not suitable for its intended audience, thereby contravening regulatory expectations for due diligence and risk management. Limiting the impact assessment to only the immediate operational implications, without considering broader customer outcomes or regulatory adherence, demonstrates a narrow and insufficient understanding of the firm's responsibilities. This oversight can lead to unintended consequences for customers and expose the firm to regulatory scrutiny for failing to consider all relevant risk factors. Professional reasoning. Professionals should adopt a structured, risk-based approach to impact assessment. This involves 1. Defining the scope, clearly outlining what aspects of the product and its launch will be assessed. 2. Stakeholder identification, recognizing all relevant internal and external stakeholders, including customers, regulators, and different business units. 3. Risk identification, brainstorming and documenting all potential risks, categorizing them by type, e.g., operational, conduct, financial, reputational. 4. Impact analysis, evaluating the likelihood and potential severity of identified risks. 5. Mitigation planning, developing strategies to reduce or eliminate identified risks. 6. Monitoring and review, establishing mechanisms to track the product's performance and impact post-launch, and to make adjustments as needed. This systematic process ensures that all relevant factors are considered, leading to more robust decision-making and adherence to regulatory and ethical standards. Question 8. The performance metrics show a significant increase in the number of investment product sales to retail clients over the last quarter. However, a review of recent client files indicates that a substantial portion of these sales involved products with higher risk profiles than the client's stated risk appetites, and in some cases, without adequate suitability assessments being fully documented. Option A. Focus on improving the documentation of suitability assessments for future sales, assuming the underlying sales decisions were appropriate, to retrospectively address any perceived gaps. Option B. Immediately halt the sale of high-risk investment products to retail clients until a comprehensive review of the sales process, suitability assessment, and staff training can be completed to ensure full compliance with FCA regulation, particularly COBS 9 suitability. Option C. Escalate the performance metrics to senior management, highlighting the positive sales figures, and request additional resources to support the sales team in meeting these targets, without explicitly mentioning the potential suitability concerns. Option D. Continue with the current sales strategy, as the performance metrics demonstrate success, and address any potential suitability issues on a case-by-case basis if they arise. The correct answer is B. Immediately halt the sale of higher-risk investment products to retail clients until a comprehensive review of the sales process, suitability assessments, and staff training can be completed to ensure full compliance with FCA regulations, particularly COBS 9, suitability. Explanation. This scenario presents a professional challenge due to the inherent conflict between achieving performance targets and adhering to regulatory requirements and ethical conduct. The pressure to meet metrics can tempt individuals to overlook or bend rules, leading to potential compliance breaches and reputational damage for both the individual and Santander. Careful judgment is required to balance business objectives with the paramount importance of regulatory adherence and client best interests. The correct approach represents best professional practice because it prioritizes a thorough understanding and application of the relevant regulatory framework, specifically the FCA's Principles for Businesses and Conduct of Business Sourcebook, COBS, in the UK context. It demonstrates a commitment to acting with integrity, due skill, care, and diligence, and to treating customers fairly by seeking clarification and ensuring all actions align with regulatory expectations. This approach mitigates risk and upholds Santander's reputation as a responsible financial institution. An incorrect approach that focuses solely on meeting the performance metric without considering the underlying regulatory implications is professionally unacceptable. This could lead to breaches of FCA principles, such as Principle 6, Customers' Interests, and Principle 7, Communications with Clients, by potentially misleading clients or recommending unsuitable products to meet targets. Another incorrect approach that involves circumventing established procedures, even with good intentions, risks violating internal policies and external regulations, potentially leading to disciplinary action and client harm. A third incorrect approach that involves ignoring the observed discrepancy and continuing with the status quo demonstrates a lack of proactive risk management and a failure to uphold professional standards, potentially exposing Santander to regulatory scrutiny and fines. The professional decision-making process for similar situations should involve a structured approach. First, identify the performance objective and the observed outcome. Second, critically assess the observed outcome against all relevant regulatory requirements, internal policies, and ethical principles. Third, if a discrepancy or potential breach is identified, seek clarification from appropriate internal channels, e.g., compliance legal line manager. Fourth, prioritize compliance and ethical conduct over short-term performance gains. Finally, document all decisions and actions taken, ensuring transparency and accountability. Question 9. The evaluation methodology shows that a financial advisor has observed a client conducting a series of unusually complex and large cash transactions over a short period, which deviates significantly from their typical financial behavior. The client has been evasive when asked for clarification on the source of these funds. The advisor is concerned about potential money laundering activities, but also values the client relationship and fears jeopardizing it by reporting. Which of the following actions best demonstrates adherence to regulatory requirements and professional best practice in this scenario? Option A. Discuss the client's unusual transactions and the advisor's suspicions with trusted colleagues in other departments to seek their opinion on how to proceed. Option B. Continue to accept the client's transactions while advising them to be more transparent about the source of their funds to avoid future complications. Option C. Discreetly report the observed suspicious activity and the client's evasiveness to the firm's Money Laundering Reporting Officer, MLRO, or designated compliance department for further investigation. Option D. Directly confront the client about the suspicion of money laundering and demand a full explanation of the source of funds before proceeding. The correct answer is C. Discreetly report the observed suspicious activity and the client's evasiveness to the firm's Money Laundering Reporting Officer, MLRO, or designated compliance department for further investigation. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activity. A financial advisor must navigate the delicate balance of maintaining client trust while adhering to anti-money laundering, AML regulations. The pressure to protect client information can be significant, but failure to report can have severe legal and reputational consequences for both the individual and the firm. Careful judgment is required to assess the materiality of the suspicion and determine the appropriate course of action without tipping off the client. Correct approach analysis. The correct approach involves discreetly reporting the suspicion to the firm's Money Laundering Reporting Officer, MLRO, or designated compliance department. This aligns with the Proceeds of Crime Act 2002, POCA, and the Money Laundering Regulations 2017, which mandate reporting of suspected money laundering. The MLRO is equipped to handle such disclosures appropriately, initiating an internal investigation and, if necessary, filing a Suspicious Activity Report (SAR) with the National Crime Agency (NCA). This process ensures compliance with legal obligations while safeguarding the integrity of the financial system and protecting the firm from regulatory penalties. It upholds the ethical duty to act with integrity and due diligence. Incorrect approaches analysis. One incorrect approach is to ignore the suspicion due to a desire to avoid upsetting the client or a belief that the activity might be legitimate. This directly contravenes the POCA and money laundering regulations, which impose a positive duty to report. Such inaction constitutes a serious regulatory and ethical failure, potentially leading to criminal charges and significant fines for both the individual and the firm. It also undermines the broader efforts to combat financial crime. Another incorrect approach is to directly question the client about the source of funds or the nature of the transactions in a way that could be construed as tipping off. Section 330 of POCA specifically prohibits tipping off a client that a report has been or is to be made. This action would alert the client to the suspicion, allowing them to conceal or move illicit funds, thereby frustrating law enforcement efforts and creating further legal jeopardy for the advisor and the firm. This is a clear breach of regulatory requirements and ethical conduct. A third incorrect approach is to seek advice from colleagues outside of the designated compliance channels without proper authorization. While seeking advice is generally good practice, doing so in a manner that bypasses the firm's internal reporting structure can inadvertently spread sensitive information, potentially leading to tipping off or compromising an investigation. It also demonstrates a lack of understanding of the firm's established AML procedures and the importance of maintaining confidentiality within the reporting process. Professional reasoning. Professionals in this situation should follow a structured decision-making process. 1. Recognize and document the suspicious activity. 2. Assess the materiality of the suspicion based on established red flags and firm policies. 3. Immediately report the suspicion internally to the MLRO or compliance department, adhering to the firm's established procedures. 4. Avoid any direct questioning or actions that could tip off the client. 5. Cooperate fully with the internal investigation and any subsequent external inquiries. 6. Maintain strict confidentiality throughout the process. Question 10. Risk assessment procedures indicate that a new automated process for anonymizing customer data prior to its use in marketing analytics has been implemented. While the process is designed to remove direct identifiers, there is a concern that the combination of remaining indirect identifiers might still allow for re-identification of individuals. What is the most appropriate course of action to ensure regulatory compliance and protect customer data? Option A. Halt all marketing analytics activities until a complete overhaul of the data anonymization process can be undertaken, regardless of the potential re-identification risk. Option B. Rely on the vendor's assurance that the anonymization software is compliant with all relevant data protection standards without independent verification. Option C. Immediately proceed with the marketing analytics, assuming the automated anonymization process is sufficient as it has been recently implemented. Option D. Conduct a thorough review of the anonymization techniques used and perform a re-identification risk assessment before proceeding with the marketing analytics. The correct answer is D. Conduct a thorough review of the anonymization techniques used and perform a re-identification risk assessment before proceeding with the marketing analytics. Explanation. This scenario presents a professional challenge because it requires an individual to balance the need for efficient data processing with the stringent requirements of regulatory compliance, specifically concerning data privacy and security. The challenge lies in identifying potential breaches of these regulations within a seemingly routine operational process. Careful judgment is required to distinguish between acceptable data handling practices and those that could lead to regulatory penalties or reputational damage. The correct approach represents best professional practice because it prioritizes a thorough, risk-based review of the data anonymization process. This aligns with the principles of data protection regulations, such as the UK GDPR, which mandate that personal data must be processed lawfully, fairly, and transparently, and that appropriate technical and organizational measures must be in place to protect data. A risk assessment specifically targeting the anonymization techniques ensures that the process is robust enough to prevent re-identification, thereby safeguarding individuals' privacy and adhering to the principle of data minimization and purpose limitation. This proactive stance is crucial for maintaining compliance and building trust. An incorrect approach that involves proceeding with the data analysis without verifying the effectiveness of the anonymization process represents a significant regulatory and ethical failure. It demonstrates a disregard for data protection obligations, potentially leading to the unlawful processing of personal data. This could result in substantial fines under data protection legislation and damage to Santander's reputation. Another incorrect approach, which is to assume that anonymization is inherently sufficient without specific validation, fails to acknowledge the nuances of data anonymization and the potential for sophisticated re-identification techniques. This oversight can lead to accidental breaches of privacy. Finally, an approach that focuses solely on the speed of data analysis, neglecting the integrity of the anonymization, prioritizes operational efficiency over regulatory and ethical responsibilities, which is a fundamental breach of professional conduct in a regulated financial environment. Professionals should adopt a decision-making framework that begins with understanding the specific regulatory obligations relevant to the data being handled. This involves identifying the type of data, its sensitivity, and the applicable legal frameworks, e.g., UK GDPR, FCA regulations. The next step is to assess the risks associated with each stage of data processing, including collection, storage, analysis, and disposal. For anonymization processes, this means critically evaluating the techniques used and their effectiveness in preventing re-identification. If any doubt exists, seeking expert advice or conducting further validation is paramount. The decision should always be guided by the principle of privacy by design and by default, ensuring that data protection is embedded into processes from the outset. Question 11. Consider a scenario where a financial institution is developing a new digital lending product. The risk assessment team is tasked with evaluating the potential risks associated with this product. One team member suggests focusing exclusively on the historical default rates of similar loan products, arguing that this provides the most objective and quantifiable measure of risk. Another suggests a broader approach, incorporating potential cybersecurity threats, regulatory compliance challenges specific to digital platforms, and the reputational impact of potential service disruptions. Which approach best aligns with robust risk management principles and regulatory expectations for a new product launch? Option A. A risk assessment that considers only the immediate financial risks, neglecting longer-term strategic or reputational considerations. Option B. A comprehensive risk assessment that incorporates historical data, cybersecurity threats, regulatory compliance, and reputational impacts. Option C. A risk assessment that focuses primarily on the speed of assessment to meet the product launch deadline, with minimal qualitative analysis. Option D. A risk assessment that prioritizes only quantitative data, such as historical default rates, to ensure objectivity. The correct answer is B. A comprehensive risk assessment that incorporates historical data, cybersecurity threats, regulatory compliance, and reputational impacts. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient risk assessment with the imperative of thoroughness and compliance with regulatory expectations. The challenge lies in identifying potential risks that might not be immediately obvious or quantifiable, and ensuring that the assessment process is robust enough to capture these nuances without becoming overly burdensome. Careful judgment is required to determine the appropriate level of detail and the most effective methods for risk identification and evaluation. The correct approach represents best professional practice because it mandates a systematic and documented process for identifying, assessing, and mitigating risks. This aligns with regulatory requirements such as those found in the UK Financial Conduct Authority, FCA Handbook, particularly SISC, Systems and Controls, and PRIN Principles for Businesses, which emphasize the need for firms to have adequate systems and controls in place to manage risks effectively. A comprehensive risk assessment, considering both quantitative and qualitative factors, ensures that potential threats to the firm's objectives, reputation, and regulatory standing are adequately understood and addressed. This proactive stance is crucial for maintaining financial stability and customer protection, core tenets of financial regulation. An incorrect approach that relies solely on historical data without considering emerging trends or new product risks fails to meet regulatory expectations for forward-looking risk management. This could lead to a breach of PRIN 3 risk management and SISC 3 systems and controls for regulated mortgage and home finance activities, which require firms to identify and manage all material risks. Another incorrect approach that prioritizes speed over thoroughness, perhaps by skipping certain qualitative risk factors or stakeholder consultations, would similarly fall short. This neglects the qualitative aspects of risk that can have significant reputational or operational impacts, potentially violating CISC 6, conflicts of interest, and CISC 7, client categorization, which require careful consideration of client impact and potential conflicts. A third incorrect approach that focuses only on risks with immediate financial impact, ignoring longer-term strategic or reputational risks, demonstrates a failure to grasp the holistic nature of risk management as expected by regulators. This overlooks the interconnectedness of various risk types and their potential cumulative effect on the firm's overall resilience. Professionals should adopt a decision-making framework that begins with clearly defining the scope and objectives of the risk assessment. This should be followed by a structured process of risk identification, utilizing a variety of methods including brainstorming, expert judgment, scenario analysis, and review of historical data and industry best practices. Subsequently, risks should be assessed based on their likelihood and impact, considering both quantitative and qualitative dimensions. Mitigation strategies should then be developed and implemented, with clear ownership and timelines. Finally, the risk assessment process and its outcomes must be regularly reviewed and updated to reflect changes in the business environment, regulatory landscape, and the firm's own operations. This iterative and comprehensive approach ensures that risk management remains a dynamic and effective tool for achieving business objectives while adhering to regulatory and ethical standards. Question 12. The investigation demonstrates that a financial advisor, while reviewing a client's recent transaction history, noticed a series of unusually large cash deposits into the client's account, followed by immediate transfers to an overseas account with no clear business purpose. The advisor recalls a casual conversation with the client where the client alluded to making a quick profit through an opportunity that came up unexpectedly. The advisor is concerned about potential money laundering, but also values the long-standing client relationship and fears damaging it with an unfounded accusation. Option A. Escalate the concerns immediately to the firm's compliance department, providing all relevant transaction details and the context of the client's remark, and await their guidance on further action. Option B. Report the suspicions directly to the National Crime Agency, NCA, without informing the firm's compliance department. Option C. Ignore the suspicious activity, as the information is not definitive proof of wrongdoing, and the client relationship is too valuable to risk. Option D. Directly contact the client to inquire about the source of the funds and the purpose of the overseas transfers, explaining the advisor's concerns about regulatory compliance. The correct answer is A. Escalate the concerns immediately to the firm's compliance department, providing all relevant transaction details and the context of the client's remark, and await their guidance on further action. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential financial crime. The employee is privy to information that, while not definitively proving wrongdoing, strongly suggests it. The pressure to maintain client relationships and avoid unnecessary alarm must be balanced against the regulatory imperative to protect the financial system from illicit activities. The ambiguity of the information adds to the difficulty, requiring careful judgment rather than immediate, potentially damaging, action. Correct approach analysis. The correct approach involves escalating the concern through the appropriate internal channels, such as the compliance department or a designated suspicious activity reporting SAR officer. This aligns with the principles of the Proceeds of Crime Act 2002, POCA, and the Money Laundering Regulations 2017, which mandate that individuals within regulated firms report suspicions of money laundering or terrorist financing. By escalating internally, the employee ensures that the matter is investigated by trained professionals who can assess the information objectively, gather further evidence if necessary, and make an informed decision about whether to file a SAR with the National Crime Agency, NCA. This process upholds both client confidentiality by not directly confronting the client without proper authorization and the firm's regulatory obligations. Incorrect approach is analysis. Directly confronting the client without internal consultation is a significant regulatory and ethical failure. It breaches client confidentiality, could tip off the client to an ongoing investigation, which is a criminal offense under POCA, and bypasses the firm's established procedures for handling suspicious activity. This approach undermines the integrity of the reporting process and could hinder a potential investigation. Ignoring the suspicious activity is a direct violation of regulatory obligations. The Money Laundering Regulations 2017 impose a duty on individuals to report suspicions. Failure to do so can result in severe penalties for both the individual and the firm. This approach prioritizes personal convenience or avoidance of conflict over legal and ethical responsibilities, leaving the financial system vulnerable. Reporting the suspicion directly to an external authority without first informing the firm's compliance department is also problematic. While the ultimate goal is to report to the NCA if warranted, bypassing internal procedures can lead to duplicated efforts, lack of internal oversight, and potential breaches of internal policies. The firm has a responsibility to manage its own reporting obligations, and internal escalation allows for proper documentation and coordination. Professional reasoning. Professionals facing such dilemmas should employ a structured decision-making process. First, identify the core conflict, client relationship versus regulatory duty. Second, consult internal policies and procedures related to suspicious activity reporting and client confidentiality. Third, gather all available objective information without making assumptions. Fourth, escalate the concern to the designated internal authority, e.g., compliance officer, in a clear and factual manner, outlining the reasons for suspicion. Fifth, follow the guidance provided by the internal authority and cooperate fully with any subsequent investigation. This systematic approach ensures that all relevant regulations and ethical considerations are addressed, leading to a responsible and compliant outcome. Question 13. Upon reviewing the onboarding application for a new corporate client, a financial advisor notes that the company has a complex ownership structure with several layers of subsidiaries registered in different international jurisdictions. The ultimate beneficial owners are individuals residing in a country with a high risk of corruption. The advisor is under pressure to meet quarterly new client acquisition targets. What is the most appropriate course of action to ensure regulatory compliance with UK anti-money laundering regulations? Option A. Onboard the client immediately to meet the acquisition targets and address any potential compliance issues retrospectively with the compliance department. Option B. Conduct enhanced due diligence, including verifying the identity of the ultimate beneficial owners, understanding their source of wealth and funds, and assessing the risks associated with the jurisdictions involved before proceeding with onboarding. Option C. Proceed with onboarding after obtaining verification of the director's identity and a general understanding of the company's business activities, as the client has provided a letter stating their compliance. Option D. Request the client to simplify their corporate structure to facilitate easier verification before proceeding with any onboarding steps. The correct answer is C. Proceed with onboarding after obtaining verification of the director's identity and a general understanding of the company's business activities, as the client has provided a letter stating their compliance. Explanation. Scenario analysis. This scenario presents a common challenge in financial services, balancing the need for efficient client onboarding with the stringent requirements of anti-money laundering (AML) regulations. The pressure to meet business targets can create a temptation to streamline processes, potentially at the expense of thorough due diligence. The professional challenge lies in adhering strictly to regulatory mandates, even when faced with time constraints or client impatience, ensuring that the integrity of the financial system is not compromised. Correct approach analysis. The correct approach involves a comprehensive understanding and application of the UK's money laundering, terrorist financing and transfer of funds, information on the payer, Regulations 2017, MLR 2017. This regulation mandates robust customer due diligence (CDD) measures, including verifying the identity of customers and understanding the nature and purpose of the business relationship. For a corporate client, this extends to identifying beneficial owners and understanding their ownership and control structures. A risk-based approach is central, meaning that enhanced due diligence (ED) should be applied to high-risk clients or situations. In this case, the complexity of the corporate structure and the involvement of multiple jurisdictions would necessitate a more thorough investigation than a simple, low-risk individual account opening. This meticulous approach ensures compliance, mitigates financial crime risks, and upholds the firm's reputation and regulatory standing. Incorrect approach is analysis. Proceeding with onboarding without obtaining satisfactory evidence of beneficial ownership and the source of funds for the ultimate beneficial owners despite the complex international structure, represents a failure to comply with Regulation 28 of the MLR's 2017, which requires identifying beneficial owners. This oversight significantly increases the risk of facilitating money laundering or terrorist financing. Accepting a simplified verification process based solely on the director's identity, without delving into the beneficial ownership of the parent company, ignores the core principles of CDD and the risk-based approach mandated by the MLR's 2017. This bypasses critical checks designed to prevent illicit funds from entering the financial system, relying on the client's assurance that all documentation is in order without independent verification of the beneficial owners, and the source of funds for the ultimate beneficial owners, is a direct contravention of the due diligence requirements under the MLR's 2017. The regulations require the firm to take reasonable steps to verify information provided by the client. Professional reasoning. Professionals must adopt a risk-aware mindset, prioritizing regulatory compliance and ethical conduct over immediate business gains. When faced with complex client structures or potential red flags, the decision-making process should involve 1. Identifying the relevant regulatory obligations, e.g., MLR's 2017 in the UK. 2. Assessing the inherent risks associated with the client and the proposed business relationship, considering factors like jurisdiction, ownership structure, and business activities. 3. Applying appropriate CDD and EDD measures based on the risk assessment. 4. Seeking clarification or additional information from the client when necessary. 5. Escalating concerns to senior management or the compliance department if uncertainties persist or if red flags are identified. 6. Documenting all steps taken and decisions made throughout the onboarding process. Question 14. Process analysis reveals that a financial advisor, while reviewing a long-standing client's portfolio, notices a series of unusually large and frequent cash deposits into their account, followed by immediate transfers to an overseas jurisdiction known for lax financial regulations. The client, when casually questioned about the source of funds, provides vague and inconsistent explanations. What is the most appropriate course of action for the advisor to take, adhering strictly to UK regulatory frameworks and professional conduct guidelines? Option A. Discreetly gather more information to corroborate or refute the suspicions, and if they persist, follow internal procedures for reporting suspicious activity to the NCA without alerting the client. Option B. Continue the business relationship as usual, as the client's explanations, though vague, are not definitive proof of wrongdoing, and avoid any further inquiry to maintain client trust. Option C. Directly question the client about the suspected illicit nature of the transactions, explaining the advisor's concerns and the potential legal implications for both parties. Option D. Immediately file a suspicious activity report (SAR) with the NCA, detailing all observations without further investigation or client interaction. The correct answer is A. Discreetly gather more information to corroborate or refute the suspicions, and if they persist, follow internal procedures for reporting suspicious activity to the NCA without alerting the client. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activity. The advisor must navigate the delicate balance of protecting client trust while upholding their duty to prevent financial crime. Misjudging this balance can lead to severe regulatory penalties, reputational damage, and a breach of professional ethics. Correct approach analysis. The correct approach involves discreetly gathering further information to confirm suspicions without alarming the client or breaching confidentiality unnecessarily. If suspicions persist, the advisor must then follow the established internal procedures for reporting suspicious activity to the relevant authorities, such as the National Crime Agency, NCA in the UK, as mandated by the Proceeds of Crime Act 2002, POCA, and the Terrorism Act 2000. This adheres to the tipping-off offense provisions, ensuring that the client is not alerted to the investigation. This approach prioritizes regulatory compliance and ethical conduct by acting responsibly upon reasonable suspicion. Incorrect approach is analysis. Immediately reporting the client without further investigation risks a breach of client confidentiality and could be considered an unfounded accusation, damaging the client relationship and potentially leading to a complaint. This fails to meet the threshold of reasonable grounds for suspecting money laundering or terrorist financing, which is required before making a suspicious activity report (SAR). Ignoring the client's unusual behavior due to a desire to maintain a good relationship or avoid confrontation is a direct failure to comply with anti-money laundering (AML) and counter-terrorist financing (CTF) regulations. This constitutes a serious ethical lapse and regulatory breach, as it allows potential financial crime to go unreported. Consulting with the client directly about the suspected illicit activity is a clear violation of the tipping-off offense under POCA. This action would alert the client to the fact that their activities are under suspicion, hindering any potential investigation and exposing the advisor to significant legal penalties. Professional reasoning. Professionals should adopt a structured decision-making process when faced with potential suspicious activity. This involves 1. Initial observation and identification of red flags. 2. Discrete internal fact-finding to corroborate or refute suspicions, always mindful of confidentiality. 3. Consultation with internal compliance or MLRO, money laundering reporting officer, if suspicions remain. 4. Following established procedures for SAR submission if reasonable grounds for suspicion are established. 5. Maintaining meticulous records of all actions taken and decisions made. This systematic approach ensures compliance, protects client interests where appropriate, and upholds professional integrity. Question 15. Examination of the data shows a high net worth client has approached their financial advisor at Santander UK with a proposal for a complex investment structure that they believe will significantly reduce their tax liability. The client is insistent that the structure is aggressive and has been recommended by an offshore introducer. The advisor has a duty to act in the best interests of the client and to comply with all relevant UK financial regulations and anti-money laundering (AML) requirements. The advisor suspects the proposed structure may be artificial and designed primarily to avoid tax, potentially crossing the line into tax evasion. Which of the following represents the most appropriate course of action for the financial advisor? Option A. Inform the client that the firm has a strict policy against any form of tax avoidance and will not engage in any discussion or implementation of such strategies, regardless of their legality. Option B. Implement the proposed structure but include a disclaimer in the client agreement stating that the firm is not responsible for any tax liabilities or penalties the client may incur. Option C. Advise the client that while the firm cannot endorse or implement schemes that appear to facilitate tax evasion, they can explore legitimate tax-efficient investment strategies that comply with UK tax law and HMRC guidelines, and recommend the client seek independent specialist tax advice on the proposed offshore structure. Option D. Proceed with implementing the proposed investment structure as requested by the client, assuming the offshore introducer has vetted its legality, to maintain a strong client relationship and secure future business. The correct answer is C. Advise the client that, while the firm cannot endorse or implement schemes that appear to facilitate tax evasion, they can explore legitimate tax-efficient investment strategies that comply with UK tax law and HMRC guidelines, and recommend the client seek independent specialist tax advice on the proposed offshore structure. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated desire for aggressive tax avoidance and the firm's obligation to adhere to regulatory requirements and ethical standards. The advisor must navigate the fine line between providing legitimate tax planning advice and facilitating potentially illegal or unethical tax evasion. The pressure to retain a high-value client adds another layer of complexity, requiring a robust decision-making process grounded in professional integrity. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing regulatory compliance and ethical conduct over immediate client satisfaction or revenue generation. This involves a thorough understanding of the UK's tax legislation, including HMRC guidance on tax avoidance and evasion. Specifically, the advisor must assess whether the proposed scheme falls within the bounds of acceptable tax planning or crosses into the territory of artificial arrangements designed solely to circumvent tax laws. The advisor's duty is to advise the client on their tax obligations and the legal implications of their proposed actions, offering compliant alternatives if the initial proposal is problematic. This aligns with the principles of professional conduct expected of individuals regulated by bodies such as the Financial Conduct Authority, FCA, and the Chartered Institute for Securities and Investment (SISI), which emphasize integrity, skill, care, and diligence, and acting in the best interests of clients within the bounds of the law. Incorrect approach is analysis. One incorrect approach involves proceeding with the client's proposed scheme without sufficient due diligence or independent verification of its legality. This would constitute a failure to exercise due skill, care, and diligence, and a potential breach of regulatory obligations to prevent financial crime and ensure client understanding of risks. It could also lead to the firm being complicit in tax evasion, resulting in severe penalties, reputational damage, and regulatory sanctions. Another incorrect approach is to summarily dismiss the client's request without exploring legitimate tax planning avenues or attempting to understand the client's underlying objectives. While avoiding problematic schemes is crucial, complete refusal without offering compliant alternatives may not represent the highest standard of client service and could be seen as a failure to act with professional competence. However, this is less severe than facilitating an illegal scheme. A third incorrect approach is to advise the client in a manner that is misleading or incomplete regarding the risks and legal standing of the proposed scheme, perhaps downplaying potential scrutiny from HMRC. This would be a direct breach of ethical duties to be honest and transparent, and could expose both the client and the firm to significant legal and financial repercussions. Professional reasoning. Professionals should adopt a framework that begins with a clear understanding of the client's objectives. This should be followed by a rigorous assessment of the proposed actions against all relevant UK legislation, regulatory guidance, e.g., HMRC guidance on avoidance schemes, and professional ethical codes. If there is any doubt about the legality or ethicality of a proposal, the professional must seek further clarification, consult with legal or tax experts, and err on the side of caution. The decision-making process must prioritize compliance and integrity, even if it means challenging or refusing a client's request. Maintaining detailed records of advice given and the reasoning behind decisions is also a critical component of professional practice. Question 16. Performance analysis shows that a client, whose stated primary investment objective is capital preservation, has recently expressed significant interest in investing in volatile digital assets like cryptocurrencies, citing potential for high returns. The advisor has previously established that the client has a low risk tolerance. What is the most appropriate next step for the advisor? Option A. Reiterate the client's stated objective of capital preservation and low risk tolerance, and discuss the inherent risks and volatility of cryptocurrencies, assessing if the client truly understands these risks and if their interest aligns with their overall financial goals. Option B. Advise the client that cryptocurrencies are not suitable for their stated objective of capital preservation and their low risk tolerance, and refuse to discuss them further. Option C. Suggest a small, speculative allocation to cryptocurrencies as a way to explore the asset class, overriding the client's stated capital preservation goal. Option D. Immediately present a selection of cryptocurrency investment products, highlighting their potential for high returns to satisfy the client's expressed interest. The correct answer is A. Reiterate the client's stated objective of capital preservation and low risk tolerance, and discuss the inherent risks and volatility of cryptocurrencies, assessing if the client truly understands these risks and if their interest aligns with their overall financial goals. Explanation. Scenario analysis. This scenario presents a common challenge in financial advisory where a client's stated investment objective, capital preservation, conflicts with their expressed interest in a volatile asset class, cryptocurrencies. The professional must navigate this discrepancy while adhering to regulatory obligations regarding suitability and client understanding. The challenge lies in balancing the client's immediate desires with their long-term stated goals and the inherent risks involved, ensuring that any recommendation is both appropriate and fully understood by the client. Correct approach analysis. The correct approach prioritizes a thorough understanding of the client's risk tolerance and financial situation before proceeding with any investment discussion, especially concerning high-risk assets. This aligns with the principles of Know Your Client (KIC) and suitability requirements mandated by financial regulators. Specifically, it reflects the duty to ensure that any investment recommended is appropriate for the client's circumstances, knowledge, and experience. By first reconfirming the client's primary objective of capital preservation and assessing their understanding of the risks associated with cryptocurrencies, The advisor upholds their fiduciary duty and regulatory obligations to act in the client's best interest. This proactive approach prevents misaligned recommendations and potential future complaints or regulatory breaches. Incorrect approach is analysis. One incorrect approach involves immediately presenting cryptocurrency investment options without first reevaluating the client's stated objective of capital preservation. This fails to uphold the suitability requirements, as it risks recommending an investment that is fundamentally at odds with the client's primary goal. It could lead to a breach of regulatory duty if the client experiences losses and claims the investment was unsuitable. Another incorrect approach is to dismiss the client's interest in cryptocurrencies outright, without exploring the underlying reasons or educating them on the risks. While capital preservation is the stated goal, a complete refusal to discuss a client's expressed interest, however risky, can be seen as a failure to provide comprehensive advice and could lead to the client seeking advice elsewhere, potentially from less regulated sources. This approach might also overlook potential diversification benefits if a small, carefully managed allocation were ever deemed appropriate after extensive risk assessment, though this is unlikely given the stated capital preservation goal. A third incorrect approach is to proceed with a cryptocurrency investment based solely on the client's expressed interest, overriding their stated objective of capital preservation, without a detailed, documented discussion and explicit client agreement to deviate from that objective. This would be a clear violation of suitability rules and the duty to act in the client's best interest, as it prioritizes a fleeting interest over a fundamental financial goal. Professional reasoning. Professionals should adopt a structured decision-making process. First, clearly identify and document the client's stated objectives and risk tolerance. Second, assess any discrepancies between stated objectives and expressed interests. Third, engage in open and honest dialogue with the client to clarify their understanding of risks and their true priorities. Fourth, educate the client thoroughly on the implications of any proposed investment, especially those with high risk profiles. Fifth, only recommend products or strategies that are demonstrably suitable and aligned with the client's confirmed objectives and risk profile, ensuring all advice is documented. Question 17. Analysis of a scenario where a financial institution's compliance officer receives an internal alert regarding a series of complex, high-value international transactions for a long-standing client. The transactions, while not directly violating any stated policy, appear unusual in their structure and lack clear commercial justification. The compliance officer suspects potential money laundering activity, but is also aware of the client's significant business relationship with the firm. What is the most appropriate course of action under the UK regulatory framework, specifically considering the Proceeds of Crime Act 2002 and FCA handbook requirements? Option A. Ignore the internal alert as the transactions do not explicitly breach any internal policies, and the client is of significant value to the firm. Option B. Immediately file a SAR with the National Crime Agency based on the initial alert without conducting any further internal review. Option C. Discuss the suspicious transactions directly with the client to seek clarification on their commercial purpose. Option D. Conduct a thorough internal investigation, documenting all findings and risk assessments, and consult with internal legal counsel before making a decision on whether to file a suspicious activity report, SAR, with the National Crime Agency. The correct answer is D. Conduct a thorough internal investigation, documenting all findings and risk assessments, and consult with internal legal counsel before making a decision on whether to file a suspicious activity report, SAR, with the National Crime Agency. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The firm's compliance officer must exercise careful judgment to balance these competing interests, ensuring that client trust is maintained while adhering to anti-money laundering AML regulations. The difficulty lies in distinguishing between legitimate, albeit unusual, transactions and those that genuinely indicate potential criminal activity. The correct approach involves a thorough, documented investigation of the suspicious activity report SAR internally before filing with the relevant authority. This demonstrates due diligence and a commitment to compliance. By gathering all available information, assessing the risk, and consulting with relevant internal stakeholders, e.g., legal senior management, The compliance officer can make an informed decision about whether a SAR filing is warranted. This process aligns with the principles of the Proceeds of Crime Act 2002, POCA, and the Financial Conduct Authority, FCA handbook, which require firms to have robust AML systems and controls, including procedures for identifying and reporting suspicious transactions. It upholds the ethical duty to act with integrity and professionalism. An incorrect approach would be to immediately file a SAR without any internal investigation. This could lead to unnecessary reporting, potentially damaging client relationships and wasting regulatory resources. It might also breach client confidentiality unnecessarily if the activity is ultimately found to be legitimate. Another incorrect approach would be to ignore the suspicious activity altogether, which is a direct violation of POCA and FCA regulations, exposing the firm to significant penalties and reputational damage. Failing to report known or suspected money laundering is a criminal offense for individuals and firms. A third incorrect approach would be to discuss the suspicion with the client before reporting. This constitutes tipping off, which is a serious offense under POCA, hindering the investigation and potentially allowing criminals to evade detection. The professional decision-making process for similar situations should involve a structured risk-based approach. First, identify the potential red flags. Second, gather all relevant information and documentation. Third, conduct an internal assessment of the risk and potential for money laundering or terrorist financing. Fourth, consult with internal legal and compliance experts. Fifth, if the suspicion persists after internal review, proceed with filing a SAR in accordance with regulatory requirements, ensuring no tipping off occurs. Finally, maintain detailed records of the investigation and decision-making process. Question 18. Compliance review shows that a client who has been with the firm for several years and typically conducts straightforward investment transactions has requested a large, immediate transfer of funds to an offshore account in a jurisdiction known for its lax financial regulations. The client has provided a vague explanation for the transfer, citing a personal investment opportunity that requires swift action. The employee handling the request feels uneasy about the suddenness and lack of detail, suspecting it might be related to money laundering. What is the most appropriate course of action for the employee in this situation, adhering strictly to UK regulatory frameworks and Santander's internal compliance policies? Option A. Directly question the client about the specific details of the offshore investment and the reasons for the urgency, informing them of the firm's suspicion. Option B. Proceed with the transfer as requested by the client, assuming the client has legitimate reasons and to avoid damaging the client relationship. Option C. Ignore the client's request and continue with their usual workload, assuming the client will eventually provide more information if the transaction is important. Option D. Immediately report the suspicious activity to the firm's Money Laundering Reporting Officer, MLRO, and await further instructions before proceeding with or rejecting the transaction. The correct answer is D. Immediately report the suspicious activity to the firm's Money Laundering Reporting Officer, MLRO, and await further instructions before proceeding with or rejecting the transaction. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the firm's regulatory obligations. The challenge lies in balancing client satisfaction with the paramount duty to comply with anti-money laundering, AML regulations. The firm must exercise careful judgment to avoid facilitating illicit activities while also maintaining a professional relationship with its client. The correct approach represents best professional practice because it prioritizes adherence to regulatory requirements, specifically the Proceeds of Crime Act 2002, POCA, and the Money Laundering Regulations 2017. By escalating the matter to the firm's Money Laundering Reporting Officer, MLRO, the employee is fulfilling their statutory duty to report suspicious activity. This ensures that the appropriate internal channels are utilized to investigate the transaction thoroughly, and if necessary, report it to the National Crime Agency, NCA, without tipping off the client. This aligns with the ethical principles of integrity and professional conduct expected of financial professionals. An incorrect approach that involves proceeding with the transaction without further inquiry would be a significant regulatory and ethical failure. It would breach the firm's AML obligations by potentially facilitating money laundering, exposing the firm to severe penalties, and undermining the integrity of the financial system. Another incorrect approach, such as directly confronting the client with suspicions without following internal procedures, could constitute tipping off, which is a criminal offense under POCA. This would alert the suspected money launderer, allowing them to evade detection and potentially destroy evidence. A third incorrect approach, such as ignoring the client's unusual request and continuing with business as usual, would be a failure of due diligence and a dereliction of the employee's responsibility to identify and report suspicious activity, thereby failing to uphold the firm's compliance framework. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the potential red flag. Recognize that the client's request deviates from normal patterns or appears unusual. 2. Consult internal policies and procedures. Refer to the firm's AML policy and employee handbook for guidance on handling suspicious transactions. 3. Escalate internally. Report the suspicion to the designated compliance officer or MLRO, providing all relevant details. 4. Follow guidance. Act strictly in accordance with the instructions received from the MLRO or compliance department. 5. Maintain confidentiality. Avoid discussing suspicions with the client or unauthorized colleagues. Question 19. Stakeholder feedback indicates that the current customer onboarding process is taking longer than desired, impacting both operational efficiency and new client acquisition rates. A proposal has been put forward to streamline the process by reducing the number of mandatory data verification checks and automating certain customer communication steps. Which of the following approaches best addresses this feedback while upholding regulatory standards and maintaining customer trust? Option A. Focus solely on accelerating the data entry and document submission phases by removing any checks deemed non-essential by the frontline staff, with the understanding that compliance can be addressed through post-onboarding audits. Option B. Conduct a comprehensive review of the entire customer onboarding workflow, involving compliance, risk, and operations teams, to identify specific points of delay. Subsequently, develop targeted solutions that automate repetitive tasks, enhance data validation accuracy through technology, and ensure all communication remains compliant with relevant regulations and customer service standards. Option C. Immediately implement the proposed changes to reduce verification checks and automate communications, aiming for a rapid reduction in onboarding time and a quick demonstration of efficiency gains to stakeholders. Option D. Prioritize the automation of customer communications, assuming that faster client interaction will compensate for any potential delays or complexities in the verification stages, and deferring a full process review until after the initial changes are in place. The correct answer is B. Conduct a comprehensive review of the entire customer onboarding workflow, involving compliance, risk, and operations teams, to identify specific points of delay. Subsequently, develop targeted solutions that automate repetitive tasks, enhance data validation accuracy through technology, and ensure all communication remains compliant with relevant regulations and customer service standards. Explanation. This scenario presents a common challenge in financial services, balancing the need for efficiency with the imperative to maintain robust compliance and customer trust. The professional challenge lies in identifying process improvements that genuinely enhance operational effectiveness without compromising regulatory adherence or the integrity of customer interactions. The pressure to demonstrate tangible improvements can sometimes lead to shortcuts or overlooking critical control points. The correct approach prioritizes a holistic review that integrates regulatory requirements and customer impact from the outset. This aligns with the principles of good governance and risk management, which are fundamental to the Santander hiring assessment test's focus on responsible financial operations. By involving relevant stakeholders, including compliance and risk teams, and conducting a thorough impact assessment, the chosen strategy ensures that any proposed changes are not only efficient, but also compliant and customer-centric. This proactive and integrated methodology is best professional practice as it embeds regulatory considerations and customer well-being into the process optimization lifecycle, thereby mitigating potential risks and fostering sustainable improvements. An incorrect approach that focuses solely on cost reduction without considering regulatory implications could lead to breaches of data protection regulations, e.g., GDPR if applicable, or equivalent UK regulations concerning customer data handling, or failure to adhere to conduct of business rules that mandate fair treatment of customers. For instance, automating customer communication without ensuring the accuracy and clarity of information provided could result in mis-selling or misleading customers, violating regulatory expectations for transparency and fairness. Another incorrect approach that prioritizes speed of execution over thorough testing and validation risks introducing errors into critical processes. This could lead to operational failures, incorrect transaction processing, or breaches of financial crime regulations if controls are bypassed or weakened. Such failures not only incur financial penalties, but also severely damage the firm's reputation and customer confidence. Professionals should employ a structured decision-making framework that begins with clearly defining the objectives of process optimization, ensuring they are aligned with both business goals and regulatory obligations. This should be followed by a comprehensive assessment of current processes, identifying bottlenecks and areas for improvement. Crucially, this assessment must include a thorough review of the regulatory landscape and potential impacts on customer experience. Solutions should then be developed and evaluated against these criteria, with a strong emphasis on risk assessment and mitigation. Pilot testing and phased implementation, coupled with continuous monitoring and feedback loops, are essential to ensure that optimized processes are effective, compliant, and sustainable. Question 20. Research into the implementation of the UK's Senior Managers and Certification Regime, SM and CR, has highlighted a common challenge for financial institutions: ensuring that all relevant employees fully understand their individual responsibilities and the firm's accountability framework. Considering the FCA's emphasis on individual accountability and conduct, which of the following approaches best demonstrates a commitment to effective and compliant implementation of SM and CR? Option A. Developing tailored training modules for different seniority levels and functions, incorporating practical scenarios and regular feedback mechanisms to reinforce understanding and identify potential gaps in knowledge. Option B. Conducting a single, broad training session for all employees that covers the general principles of SM and CR without delving into specific role-based obligations. Option C. Implementing SM and CR requirements based on existing internal policies and procedures, with minimal consultation with business units to avoid disruption. Option D. Distributing a comprehensive SM and CR policy document to all staff and assuming that reading and understanding the document is sufficient for compliance. Correct answer is A. Developing tailored training modules for different seniority levels and functions, incorporating practical scenarios and regular feedback mechanisms to reinforce understanding and identify potential gaps in knowledge. Explanation. Scenario analysis. This scenario presents a professional challenge rooted in the implementation of new regulatory requirements within a financial institution. The core difficulty lies in balancing the imperative to comply with evolving regulations, specifically the UK's Senior Managers and Certification Regime, SM and CR, with the practicalities of embedding these changes into daily operations and ensuring all relevant staff understand their new responsibilities. The challenge is amplified by the need to achieve this without disrupting existing business processes or creating undue burden on employees, while simultaneously mitigating the risk of non-compliance, which can lead to significant reputational damage and financial penalties. The firm must demonstrate to the Financial Conduct Authority, FCA, that it has taken all reasonable steps to ensure its senior managers and certified staff are competent and aware of their obligations. Correct approach analysis. The correct approach involves a structured, phased implementation that prioritizes comprehensive training and clear communication tailored to different roles and responsibilities under SM and CR. This aligns with the FCA's expectations for firms to proactively manage conduct risk and accountability. By developing role-specific training materials, conducting interactive workshops, and establishing ongoing monitoring mechanisms, the firm demonstrates a commitment to embedding SM and CR principles into its culture. This proactive and targeted strategy ensures that individuals understand not just the letter of the regulation, but also its practical implications for their day-to-day work, thereby fostering a culture of accountability and compliance. This approach directly addresses the FCA's focus on individual accountability and the need for firms to have robust internal processes to support it. Incorrect approaches analysis. A generic, one-size-fits-all training session that covers SM and CR broadly, without addressing specific role-based responsibilities, fails to meet the FCA's expectations for effective implementation. This approach risks leaving individuals unclear about their precise obligations, leading to potential breaches and a lack of accountability. It is a superficial attempt at compliance rather than a genuine embedding of the regime. Relying solely on a published policy document without any accompanying training or communication is also a significant failure. While policies are essential, they are insufficient on their own to ensure understanding and adoption, particularly for complex regulatory frameworks like SM and CR. This approach neglects the human element of implementation and assumes passive comprehension, which is unrealistic and ethically questionable, as it fails to adequately inform and equip staff. Implementing SM and CR changes without consulting with relevant business units or seeking feedback from staff creates a disconnect between regulatory requirements and operational reality. This can lead to impractical procedures, resistance to change, and ultimately, noncompliance. It demonstrates a lack of due diligence in understanding the impact of the regulation on the business and its people, which is a failure in professional judgment and regulatory adherence. Professional reasoning. Professionals facing such implementation challenges should adopt a systematic approach. This involves 1. Thoroughly understanding the regulatory requirements, SM and CR in this case, and their specific implications for the firm. 2. Conducting a gap analysis to identify areas where current practices fall short of regulatory expectations. 3. Developing a detailed implementation plan that includes clear objectives, timelines, and resource allocation. 4. Prioritizing stakeholder engagement, including senior management, business units, and compliance teams, to ensure buy-in and gather diverse perspectives. 5. Designing and delivering targeted training and communication programs that are role-specific and practical. 6. Establishing robust monitoring and review mechanisms to assess the effectiveness of the implementation and identify areas for improvement. 7. Maintaining clear documentation of all implementation activities and decisions to demonstrate compliance to regulators. This structured and inclusive process ensures that regulatory changes are not merely adopted, but are effectively integrated into the firm's operations and culture.